Programmable. That single word appears 17 times in the Federal Reserve's research papers on central bank digital currency. Not convenient, not efficient, programmable. And if you don't understand what programmable money means for your financial freedom, I need you to pay very close attention to what I'm about to explain. Because programmable doesn't just mean digital. You already have digital money. The balance in your bank account is digital. What programmable means is money that can be coded with rules. Money that can be told where it can be spent, when it can be spent, and whether it can be spent at all. The Federal Reserve is actively researching a digital dollar. The Bank for International Settlements coordinates CBDC development across 130 countries. The infrastructure is being built. And buried in the technical specifications are capabilities that should concern anyone who values financial autonomy. While you were focused on inflation rates and interest rate decisions, central banks worldwide have been quietly developing something far more consequential: a fundamental redesign of money itself. According to the Atlantic Council's CBDC tracker, 130 countries, representing 98% of global GDP, are now exploring central bank digital currencies. 11 countries have fully launched CBDCs. The United States has published multiple research papers and conducted pilot programs. This isn't theoretical future technology, it's active development happening now. The Federal Reserve's own publications describe CBDC features including transaction monitoring, spending controls, and the ability to implement monetary policy directly through individual accounts. Features that privacy advocates, economists, and even some Federal Reserve officials have flagged as concerning. The question isn't whether CBDCs are coming. The development is documented. The question is what capabilities they'll include, and whether citizens understand the implications before implementation. Now, let me be clear about sources before we continue. I'm drawing from Federal Reserve research publications, Bank for International Settlements working papers, congressional testimony, academic research on CBDC design, and documented examples from countries that have already implemented digital currencies. These aren't fringe sources. These are central banking institutions describing their own research in their own words. I'm not claiming secret conspiracies. I'm presenting publicly documented capabilities that central banks themselves acknowledge they're developing. Capabilities whose implications deserve broader public discussion. The technical papers are public. The pilot programs are documented. The concerns I'm raising come from economists, privacy organizations, and policymakers across the political spectrum. By the end of this video, you'll understand exactly what CBDC programmability means, what capabilities are being built into digital currency systems, and what historical precedent tells us about how governments use financial control mechanisms once they exist. Because here's what most people don't realize. The ability to freeze, limit, or control individual financial access isn't theoretical. It's already been deployed in countries with advanced financial infrastructure. The mechanisms exist. The precedents are set. There's a documented pattern here. A pattern where financial control capabilities, once built, expand beyond their original stated purpose, where emergency powers become routine, where technical possibility becomes policy reality, same sequence across jurisdictions, same expansion of scope, same eventual application to ordinary citizens. The only question is whether you understand what's being built while public input might still influence design, or whether you'll discover the implications only after the infrastructure is operational. Stay with me. The next 15 minutes will illuminate capabilities that most people don't know exist. To understand what CBDC programmability actually enables, you need to understand the fundamental difference between current digital money and central bank digital currency. The distinction isn't technical detail, it's the difference between privacy and surveillance, between autonomy and control. Current digital money operates through a layered system with crucial characteristics. Current system, intermediated privacy. When you make a transaction today, your bank sees it. But the Federal Reserve doesn't see individual transactions. There's a layer of separation between you and the central bank. Banks can freeze accounts, but doing so requires legal process, regulatory justification, and creates paper trails that can be challenged. The system has privacy gaps, certainly, but it also has friction that limits instantaneous arbitrary control. CBDC system, direct central bank access. A central bank digital currency, by design, creates direct relationship between you and the Federal Reserve. Depending on design choices, the central bank could see every transaction in real time. More significantly, programmability means rules can be embedded in the currency itself. The Bank for International Settlements has published research describing these capabilities explicitly. The Programmability Framework. Central bank publications describe several programmable capabilities. Expiration dates, money that must be spent by a certain date or loses value, described as a tool for stimulating spending during economic downturns. Spending restrictions, money that can only be spent on approved categories, described as potential implementation for targeted stimulus or benefits, geographic limitations, money that can only be spent in certain areas, described as a tool for supporting local economies, transaction limits, caps on how much can be spent or transferred, described as anti-money laundering tools, conditional freezes, ability to restrict account access based on defined conditions, described as compliance and enforcement capability. Each capability is presented in policy papers as a beneficial tool. Each capability also represents unprecedented control over individual financial freedom. Now, let me show you how similar capabilities have already been used. 3 examples, 3 jurisdictions. Same pattern of capability expansion, Canada. The trucker convoy financial freeze. This example matters because it happened in a modern Western democracy with strong rule of law traditions, and because it demonstrated capabilities most Canadians didn't know existed. In February 2022, protests against COVID vaccine mandates blocked streets in Ottawa and border crossings. The Canadian government declared a national emergency under the Emergencies Act. What happened next shocked observers worldwide. The government ordered financial institutions to freeze accounts of individuals connected to the protests, not through traditional court orders requiring individual judicial review. Through emergency directive applied broadly, banks froze over 200 accounts. Payment processors cut off donation platforms. Crowdfunding sites were ordered to freeze millions in donated funds. Personal accounts of individuals who had donated as little as small amounts were frozen. People who weren't at protests but had contributed financially found their accounts inaccessible. The freezes occurred without criminal charges, without court orders naming specific individuals, without traditional due process protections. Within days, the Emergency Act was revoked. Many accounts were unfrozen, but the precedent was established. A modern Western democracy demonstrated that it could freeze citizen accounts rapidly based on association rather than individual adjudication when it deemed circumstances warranted. And this occurred using existing banking infrastructure without CBDC. Imagine the speed and scope possible with programmable currency that requires no bank intermediation. The Canadian example proved that the capability exists. The friction of the current system slowed implementation but didn't prevent it. CBDC removes that friction entirely. 2021 to present. China, the digital yuan social integration. This example matters because China's CBDC is the most advanced implementation by a major economy, and because it reveals how programmable money integrates with broader social control systems. China launched its digital yuan, the eCNY, through expanding pilot programs reaching hundreds of millions of users. The technology is real, deployed, and observable. China's CBDC includes features that American and European central banks discuss theoretically, but China implements practically. Expiring stimulus. During COVID recovery, China issued digital yuan with expiration dates. Citizens received funds that had to be spent within weeks, or they would disappear. This drove rapid spending, but also normalized the concept of money that can be programmed to expire. Controllable anonymity. Chinese officials describe the eCNY as offering controllable anonymity. Small transactions are relatively private, but the central bank maintains ability to access transaction records when deemed necessary. Privacy exists at government discretion, not as inherent right. Integration potential. China's digital yuan operates in a country with an existing social credit system. While direct integration isn't officially confirmed, the technical capability to link financial access to social scores exists. Observers have documented cases where Chinese citizens with low social credit scores face restrictions on travel and purchasing. The social credit system is controversial, but its existence demonstrates the endpoint of programmable control systems. Financial access becomes conditional on behavior government approves. American officials insist such systems wouldn't be implemented here, but the technical capability, once built, exists independently of current policy intentions. China's implementation proves the technology works at scale. The policy choices made with that technology depend entirely on who controls it and what constraints limit their power. 2023 to present, Nigeria. The failed eNaira implementation. This example matters because it shows what happens when governments push CBDC adoption aggressively and how populations respond when they recognize the control implications. Nigeria launched the eNaira in October 2021, becoming one of the first countries globally to implement a CBDC. The government had ambitious adoption goals. To accelerate adoption, the Nigerian government implemented aggressive measures. They limited ATM withdrawals to push citizens toward digital alternatives. They restricted cash availability. They mandated certain transactions occur digitally. The population's response was not what the government expected. Nigerians largely rejected the eNaira. Adoption rates remained minimal despite government pressure. Citizens found workarounds to access cash. Black markets for physical currency emerged. The resistance wasn't technophobia. Nigeria has high mobile payment adoption through private services. Citizens specifically rejected the government-controlled digital currency while embracing private alternatives. Why? Nigerian citizens, with direct experience of government overreach, recognize the control implications of state-monitored programmable money. The Nigerian example reveals a crucial dynamic. Populations that understand what CBDCs enable often resist adoption. This explains why CBDC development often occurs with minimal public debate. Informed populations are skeptical populations. 3 examples. Canada demonstrated that financial freezing of citizens occurs in Western democracies when governments deem it necessary. China demonstrated that programmable money integrates with social control systems. Nigeria demonstrated that informed populations resist. The pattern suggests that CBDC implementation succeeds when populations do not understand the implications until after systems are established. Now let me show you where US CBDC development actually stands, and what the documented research reveals about intended capabilities. Federal Reserve research. The Federal Reserve has published multiple papers examining CBDC design. The Boston Fed partnered with MIT on Project Hamilton to develop CBDC technical infrastructure. Research continues despite political controversy. Fed publications describe CBDC potential benefits: faster payments, financial inclusion, monetary policy transmission. But they also acknowledge the control capabilities inherent in the technology. A 2022 Federal Reserve paper explicitly noted that CBDC design choices involve trade-offs between privacy, compliance, and monetary policy effectiveness. The paper acknowledged that full transaction visibility would be technically possible. The programmability acknowledgement. Bank for International Settlements research, which coordinates central bank CBDC efforts globally, explicitly describes programmability as a feature, not a bug. A BIS paper noted that programmable money could enable targeted monetary policy affecting specific populations, direct implementation of negative interest rates on holdings, spending incentives or restrictions based on policy goals. Each capability represents unprecedented government control over individual financial decisions. Current legislative debate. CBDC development has generated bipartisan concern in Congress, though for different reasons. Some legislators oppose CBDCs over privacy and surveillance concerns. Others worry about government overreach. Bills have been introduced to prohibit Federal Reserve CBDC issuance without congressional authorization. The debate exists because legislators who've examined the technology understand its implications. The integration risk. The most concerning scenarios involve CBDC integration with other systems. Digital identity requirements could link financial access to verified identity, excluding those who resist digital ID adoption. Tax compliance could become automatic, with authorities having direct visibility into all transactions and automatic authority to freeze assets for perceived violations. Benefits distribution through CBDC could come with spending restrictions, controlling what assistance recipients can purchase. Carbon tracking could link purchases to environmental impact scores, enabling restrictions on high carbon consumption. Each scenario exists in policy discussions or pilot programs somewhere globally. Each becomes technically trivial once programmable CBDC infrastructure exists. The convenience rollout. If historical pattern holds, CBDC introduction will emphasize convenience, faster payments, lower fees, financial inclusion. The control capabilities will be described as theoretical safeguards, rarely used, subject to strict oversight. But once infrastructure exists, capability is permanent. Policy changes are temporary. What's impossible without CBDC becomes possible with it. What's possible eventually becomes actual when political conditions shift. The infrastructure being built now will exist for decades. The political constraints on using its full capabilities will fluctuate with elections, crises, and changing norms. Building the infrastructure means trusting every future administration with capabilities that current proponents promise won't be abused. Now I know what some of you are thinking. Let me address the counter-arguments directly. But the Fed says American CBDC will protect privacy. Current Fed officials express commitment to privacy, but officials change, policies change, technical capabilities persist. The same Federal Reserve that promises privacy designed a system where privacy is a policy choice, not an architectural guarantee. A future administration could change the policy without changing the infrastructure. Moreover, privacy with exceptions for law enforcement and compliance isn't privacy. It's surveillance with marketing language. But we already have surveillance through banks and credit cards. This isn't new. Current surveillance is fragmented and intermediated. Different banks have pieces of your financial picture. Assembling the complete view requires legal process and coordination. CBDC centralizes surveillance by design. One system, complete visibility, real-time access. The qualitative difference is significant, and crucially, current systems don't enable programmable restrictions. Your credit card company can decline a transaction for fraud. They can't program your dollars to be unspendable on categories they disapprove of. But Congress would never allow account freezing of ordinary citizens. Congress didn't specifically authorize the Canadian freezes. Emergency powers were invoked. Similar emergency authorities exist in the United States. And consider, once infrastructure enables something, the question becomes when it will be used, not whether. Every expansion of government capability eventually gets used, often for purposes beyond original intentions. But I have nothing to hide. Surveillance doesn't affect me. Today's legal activity can become tomorrow's prohibited activity. Regulatory interpretations shift, political climates change. Citizens who donated to mainstream political causes have found themselves targeted when administrations changed. People engaging in legal activities have faced financial restrictions when policy shifted. Nothing to hide assumes permanent, perfect knowledge of what future authorities will find objectionable. History suggests that's a dangerous assumption. But CBDC is inevitable. Resistance is pointless. Design choices aren't inevitable. A CBDC that preserves privacy and limits programmability is technically possible. A CBDC that maximizes surveillance and control is also possible. Which design prevails depends on public pressure during the development phase. The window for influencing design exists now, before implementation. After implementation, changing architecture becomes extremely difficult. Informed public engagement can influence design choices, but only if the public understands what's being built. So what does this mean for you? Practically. Specifically. Right now, I'm not telling you to do anything illegal. I'm not giving financial advice. I'm sharing information about developments that will affect everyone, and options that exist while they still exist. First, understand what's being developed. Read the Federal Reserve's CBDC research papers. They're public. They're readable. They describe capabilities in their own words. Understand what programmable money means. Understand what transaction visibility enables. Understand the difference between current and proposed systems. Informed citizens make different choices than uninformed citizens. That's why this information matters. Second, recognize the implementation timeline. Full CBDC implementation likely remains years away. Pilot programs continue. Legislative debate continues. Design choices aren't final. This means a window exists for public engagement, contacting legislators, supporting organizations advocating for privacy-preserving design, participating in public comment periods. The time to influence design is before implementation, not after. Third, consider financial diversification. Not all assets are equally susceptible to programmable control. Physical cash remains outside digital systems. Precious metals exist independently of banking infrastructure. Some decentralized cryptocurrencies offer transaction privacy by design. I'm not recommending any specific asset. I'm noting that assets vary in their susceptibility to digital control mechanisms. Fourth, support privacy-preserving alternatives. Payment systems that don't require surveillance exist. Cash remains an option. Some digital systems prioritize privacy. Using privacy-preserving options, where legal and practical, maintains their viability. Systems atrophy without use. Maintaining alternatives preserves optionality. Fifth, understand the stakes. Financial privacy isn't abstract. It's the ability to support causes you believe in without facing repercussions. To make legal purchases without judgment. To maintain autonomy over your own resources. Once lost, privacy is extremely difficult to recover. The architecture being built now will persist for decades. Understanding the stakes clarifies why engagement matters while design remains unfinal. If this analysis provided value, subscribe to The Silent Economy and hit the notification bell. I release new research weekly, and the next video breaks down exactly which assets and systems preserve financial privacy, the specific trade-offs involved, and how different jurisdictions are approaching these questions differently. Drop a comment below. Tell me your concerns about CBDC development, whether you're seeing these discussions in your community, what questions remain unanswered. I read every comment. This channel grows through engaged discussion with people who recognize that the most important policy debates often occur before most people realize decisions are being made. Here's what I want you to remember. The Federal Reserve and central banks worldwide are developing programmable money. The capability to freeze, limit, or control individual financial access is being built into the architecture. These aren't conspiracy theories. They're documented features described in central banks' own research papers. The question isn't whether this technology is coming. It's what capabilities it will include and what constraints will limit their use. Canada demonstrated that Western democracies freeze citizen accounts when they deem it necessary. China demonstrated that programmable money integrates with social control. Nigeria demonstrated that informed populations resist. The window to influence design exists now. After implementation, architecture becomes permanent while policies remain temporary. Thanks for watching The Silent Economy. And remember, The people who preserve their autonomy aren't always the ones who trusted institutions to protect them. They're the ones who understood what was being built and positioned accordingly while they still could. The research papers are public. The capabilities are documented. The choice to pay attention is yours.